Oil prices fell for a fourth straight session on Tuesday as strong US economic data bolstered the view that the Federal Reserve will keep interest rates higher for longer. US benchmark West Texas Intermediate traded near $88 a barrel after declining by 2.2% in the previous session. WTI has now dropped around 6% since last Wednesday's close on fears over the global economy. Meanwhile, global benchmark Brent is hovering around the $90 mark. Analysts also noted that a key oil pipeline between Iraq and Turkiye, which is ready for operations this week, could result in additional oil flows and ease global supply tightness. For more on this now, let's bring in Neil Wilson, Chief Market Analyst at Finalto. Neil, thanks for joining us this morning. Now, last quarter, we saw oil surge by around 30%. Why this sudden drop now?
Yeah, well, so I think partly it's explained by the pace of the gain. So it really did explode higher. So I think there's a natural tendency among some of the speculators, at least, to take some profits. I think we maybe seen that run up get a little bit extended. I think also, as you say in your piece, that there has been this sort of message, very clear message from the Fed and others about higher for longer. In terms of the interest rate picture in the US, and it's a sort of similar story being told elsewhere in the West. And I think there are some concerns about recession. I think you did see the move was quite one-sided. It was really on the supply. It was seen that there was a lot of tightness in the supply, and I think it was very much concentrated in these sort of front months where there was a scramble, or there is still a bit of a scramble for barrels. And that pushed the futures curve deeply into backwardation. So you saw prices, near month prices, a lot higher, about $10 higher than 12 months out. And that was indicative, I think, of just the sort of the tightness of the physical market right now. That's maybe easing a bit. There's maybe some sense that it's not quite as bad as all that. But we still see global inventories way down. We see stocks at Cushing in Oklahoma way down. So I think this is probably more of a temporary pullback before we make another push higher.
Right, and analysts had been talking up the prospect of prices hitting the $100 mark a barrel. Is that still a possibility?
Yeah, I would say for sure. Yeah, it kind of dependent on the physical market. I think if we see resilience really in the US, and you see manufacturing, the PMI out of China over the weekend, that was ticking up for the first time in 6 months. So seeing some, continued resilience, although in Europe's looking a bit soft, but that resilience in demand in the US and also in China, I think you see inventories continue to come under pressure, and that will push the physical market into more deficit, and that's going to put more of a pressure on those front months. I think we see the front months still nudging higher and pushing up towards that $100 mark. How long it can be sustained at that level is unclear because we don't know what the economic picture is for next year.
Okay, well, Neil Wilson, that's all we have time for today. Thank you for your analysis. Now to other top stories from around the world. The Reserve Bank of Australia kept interest rates on hold for a fourth straight month at 4.1%. It's the latest decision made by the new governor, Michelle Bullock, a move that will likely give mortgage holders some small reprieve. Bullock has warned that Australia is not out of the inflation woods just yet, and that further rate hikes are possible. Shares in Evergrande have surged as much as 42% as trading resumed in Hong Kong after a 2-day suspension. The embattled Chinese property developer had halted trading after its billionaire founder was investigated by authorities. Evergrande, whose liabilities exceed $340 billion, is at the center of a real estate market crisis threatening the world's second-largest economy. And Ford and General Motors are indefinitely laying off another 500 workers at 4 plants, blaming the knock-on effects caused by strikes. Last month, the United Auto Workers struck against all 3 Detroit car makers simultaneously for the first time in its 88-year history. Analysts estimate that the action has already cost the US economy more than $4 billion.